Okay, guys, the next thing we're going to go over is loan officers. What is a loan officer? A loan officer is a representative of a bank, credit union, or other financial institution that finds and assists borrowers in acquiring loans. Loan officers can work with a wide variety of lender products for both consumers and businesses. They have a comprehensive awareness of lending products as well as banking industry rules, regulations, and required documentation. Two things I want to elaborate on in there. Lending products. So in here, we're talking about acquiring loans. People have loans for different reasons. One can be, I need a loan to buy a house. Another thing might be that I might already own a house, but I want to change my loan on it. That might be a refinance. Another thing might be I'm going to be retiring soon, and I've had this home for a really long time. Maybe I need a reverse mortgage where I take money out of my home that I own. So there are different lender products and different variations of these types of loans that a consumer might receive. Another thing to elaborate on is what is a loan officer? Loan officer is a very common name. It's the more official name for what a lender is. But also they give themselves elaborate titles all over the place. And I want you to know they all mean the exact same thing. So you might see a loan officer say that they are also a lender, or that they are the vice president of lending, or senior mortgage counsel, or senior mortgage associate. All of these elaborate names are really just for someone to give themselves a title that hopefully helps them with whatever their efforts are. At the end of the day, someone that is giving you a loan is a loan officer. Breaking down loan officer. Loan officers communicate with numerous individuals to facilitate the lending process for banking clients. Loan products that may involve a loan officer can include personal loans, mortgage loans, and lines of credit. So we kind of talked about those, a few different versions over there. Lending procedures. Loan officers are a direct source of contact for borrowers seeking loans from financial institutions. Many borrowers prefer working with a loan officer directly to ensure all of their needs are met. While traditional bank lending procedures can often be more time-intensive, the personal interaction gives borrowers greater confidence in executing a lending deal. Loan officers work with a borrower to provide consultation, application, underwriting, approval, and deal closing service. They have knowledge and access to all types of loans offered by the financial institution for which they represent, and can provide consultation to borrowers on the best loan for their individual needs. When a borrower decides on a loan product, the loan officer helps guide them through the application. From there, they also initiate the analysis of institutions, underwriter who analyzes and assesses the credit worthiness of potential borrowers for loan approvals. So to give you an idea there of what that really translates to, if I'm buying a home, I don't just get to go into a bank and say, hey, can I borrow some money for this home? There's a representative there that's going to pre-qualify me and say, let's see what your income looks like. Let's see what your credit score looks like. What's your financial health over the last couple months? Let me get an idea of what you look like. And if that looks good, maybe you get a pre-approval. And then somebody else is going to go and cross-reference that information. Say, give me your last W-2s. Give me your last couple paychecks. I want to see your bank statements, et cetera, et cetera. And then beyond that, when you have a transaction that you're getting ready to work on, they're also going to cross-reference this home with other things. Is this home worth what you're paying for? Has anything come up since we first pre-approved you a few months ago? They're going to do all these things to ensure that you're able to get the actual proper funding for this transaction, or funding for remodeling, or funding for adding a pool to the house. For whatever that is, they're going to be the ones that check you out. Lending documentation. If a borrower is approved for a loan, loan officers are responsible for researching and presenting the appropriate documentation and loan closing documents to ensure compliance. The documentation required for a loan is often automatically generated by a financial institution's lending system, which has been programmed based on the rules and regulations governing each type of loan. Secured loans will generally have a greater amount of documentation required than unsecured loans. Mortgage loans specifically must adhere to a range of regulated documentations, which varies by the type of loan being closed. All types of loan will require a closing statement, each with its own documentation requirement. Standard mortgage loans must include a closing disclosure that has to be provided to the borrower 3 days before the loan is closed. Reverse mortgages and mortgage refinancing require a HUD-1 settlement statement to close the loan, which must be provided 1 day prior to close. There's lots of deep details in there. The main things that you need to know is when someone is going to give you a loan, there's going to be lots of paperwork and information that's shared. Like I mentioned, on the borrowing side, you're going to say, I'm well qualified to borrow this money and I'm getting a normal home. There's no red flags over here. Unsecured loans are a little bit more risky. It's saying, hey, I might not be in good shape to get this loan, but guess what? I need the loan for a short-term thing. I'm going to flip this property and make it look something beautiful. And I'm going to gain a big profit. It's a little bit of a different thing. So there is some risk involved. The other documentation that you're seeing, these disclosures. Now, a lot of times when someone's letting you borrow money, saying, hey, I'm going to give you $300,000 to go purchase this home. It may not be apparent to you what borrowing that $300,000 means. Do you know that if you borrow $300,000 over 30 years right now, that you're probably going to be paying back maybe $700,000? They want to make sure that you know this. This is something that they cover. This is something that is in the documentations to make sure that you know exactly what you're getting into, which is a long-term commitment. So lots and lots of documentations in there. Loan officer commissions. Some loan officers are compensated through commission for the role that they play in the lending process. This commission is a prepaid charge and is often negotiable. Commission fees are typically the highest in mortgage loans, providing compensation to a loan officer for the broad range of services they provided throughout the lending process. So there are different types of loan structures. You know, you can be a loan officer and working for a certain lending broker who does tons of marketing, and all you have to do is pick up the phone and give people money. And there's other ones where you're like self-employed just the same way the realtors. You don't know when you're going to get your next deal done. And guess what? You go find it yourself, but maybe it's a bigger payout. Generally speaking, you know, kind of the same deal applies. You don't get paid until you let someone borrow that money. And if you don't let that person borrow that money, you're not getting paid out. And when you're giving them the money to borrow, you need an agent over there to get that transaction through so everybody gets paid and everybody is happy. And that's the dynamic. And that's what's going to lead into our product, making sure that those relationships are nice and strong and that loan officers want agents to love them to get more of these deals funded. Okay? So that is going to be everything about loan officers, who again have a million names. Thanks, guys.